get me? Take care, take care, take care.
Welcome to Looking at the Markets with David Modell. Hey, you get to see me today, and you get to see my guest of honor today, a returning guest. He is Mr. Seth Golden from the Golden Capital Portfolio. Today, he is dressed perfectly for today's topic, which is Fitbit. He looks ready to exercise. Yep, there. Uh-oh, there it is. Look out. All right. Mr. Seth Golden has had amazing returns with Golden Capital Portfolio. We're going to talk about that today. But mostly we're going to talk about Fitbit. Is it competitive? Can we take a position in Fitbit with confidence? Or if you already have a position in Fitbit, should you hold it? Should you dump it? I don't know. We've got a lot to learn today. So, Mr. Golden, welcome back, sir, to Looking at the Markets.
Thank you for having me back, David.
Yeah, it's great. It's great to have you here always. You've got such insight into, last time we talked about volatility products, and that's cool. But today we're going to mostly focus on retail and especially Fitbit and its competitor or competitors. So first of all, Fitbit, I'm just curious. First of all, does Golden Capital Portfolio get involved with Fitbit as a long position on a regular basis?
Yes, I've actually held the position in the portfolio for about a year now. I've had to do some dollar cost averaging, obviously. Last year, the dollar cost average was just under $12. The stock is just under $6 now. Fortunately, I made some very timely trades, and I've been able to get that cost lower to under $8 a share. So what I like about the company or the stock as an investment from here is it's doing the typical things that I've seen in consumer packaged good categories in the past. So I have a lot of confidence from here going forward that the share price will lift, the investment will have a nice, return on capital. So I'm confident, if somebody was desired to take a position here. In fact, I raised my rating on the stock in my last article, which was a quarterly recap of their Q2 results. I raised it from basically a hold to accumulate, which is the equivalent of a buy.
Right.
I also assigned a 12-month price target of $7.25, which may prove to be a modest target, but we'll see how it goes.
Yeah. Now, what would give you confidence in Fitbit at this point? Is it the leadership in the company? Is it just the fundamentals? What makes you feel that you should hold, or again, we're not telling people what to do, what not to do,
right.
But what would give you confidence in holding this position?
Yeah, so Fitbit is going through the typical life cycle or business cycle of a consumer packaged good company. I've seen this cycle play out before with Keurig Green Mountain, with SodaStream, with GoPro, with Skull Candy, you name it. And what essentially, there's three main cycles, especially after the IPO. You go through a period where you build out your product line. That's in the early stages. The next stage is distribution. You have to set up your distribution channels, whether it's locally or internationally. And going into the IPO, that's the phase of the business cycle that Fitbit was in. They were expanding their distribution channels. Through the 2016 year, they pretty much topped out. They had saturated the market around the world. I mean, sure, there's a few more retailers to go into, but it's not incremental. So that's what we call saturation point. And what tends to happen is after you reach that saturation point, you're left with what is called true demand or sell-through. And that's the final stage of let's call it the boom to bust cycle. And true demand is always slower than the distribution pipeline building and the network building. So when you reach that saturation point, unfortunately your sales fall, And best case scenario is that management would foresee that coming. They'd know where their saturation point is, and they would have built out capacity to recognize that saturation point so that the profit margins don't shrink or contract once you hit that saturation point. But unfortunately, that didn't happen with Fitbit. They, during the expansion phase, you build a lot of fat around the company. You're just spending money. You got to nail this account. You got to get that retailer on board. You got to get this major distributor in Japan or Korea on board. And you do whatever you can. You got all this IPO money, and it's a land grab. So right now, so Fitbit basically busted the IPO. Stock fell from the 40s or maybe the 50s all the way down to $5 a share. So this year in 2017, coming into 2017, they issued a restructuring plan, and the restructuring centered on trimming the fat. Well, we built up all this fat around the business. Now we need to streamline. We know what the true demand is at this point. There's not really a lot of places to expand into, and they're not incremental. So we're going to, streamline operations, raise capacity to a level that meets that true demand, that sell-through from my retailer to an actual consumer, and eventually come out a leaner company and one that can get back to profitability. Sales will take a little longer to reach, where they peaked out in 2016, around $2.5 billion in sales. But again, I've seen that before. Perfect example is SodaStream. SodaStream peak sales were early 2013. They had achieved about $550 million in sales all the way back in 2013. It's only here in 2017 that they're getting back to that point. However, just like Fitbit, what they did between 2013 and in 2016 is restructure the company, trim the fat, raise your gross profit margins, and now they're making more money, more actual net income, more cash flow. They got $100 million on their balance sheet, no debt. And that's what Fitbit is trying to do at this point. You go through a period where you're basically bottoming and to resurge. And probably by the end of this year, you'll see a nice resurgence. In fact, that's what they forecasted on their last earnings call, is they expect to actually be flat, when it comes to profits, be flat year over year, and which could bolster next year's performance. You have easy comps here. 2017, you just have really bad comps. 2018, those are really easy to get over. And when you trimmed all that fat off the business, it's a really nice profit picture. So, sorry, that was a little long-winded. That's
okay. Very informative, though. Now, they survived, if that's the right word, Q2 earnings. But, there's going to be another one in 3 months and then another one 3 months after that. Are you just going to hold through these? Are you going to trim your position? What's your plan for that?
Yeah, so my core position, that I've had for over the last year, I'm just going to keep that intact and look for trading opportunities. In fact, I posted a couple of trades within the last, just prior to the earnings release, I had acquired shares. I acquired those shares in the face of a Cleveland research notes that came out that said, we're lowering our estimates, we're afraid that demand simply isn't there. What Cleveland research didn't really take into account is, while that's true, how do you know what level of inventory is in the channel? You might know the sell-through, but you don't know what the sell-in was. And that's what these consumer packaged good companies report. They only report what they sell into the channel, not what sells through the channel. So while their notes may have been accurate, that's not what these companies report. Fitbit does not report the true demand, what's sold through the channel. What you optimally hope for is that they're level setting. And that's exactly what happened. So the results were better than expected. They beat on both the top and the bottom line, and they even beat on the gross profit margin. That gives me a lot of confidence. But ultimately, what gives me the greatest confidence when it comes to holding or maintaining my position is clean inventory levels. I've been waiting to hear that for the last, let's say, 6 months. It takes a while. When you flush these retailers and your distributors with tons of product because it's new to them, and they don't really know how fast it'll sell through their establishment, it can take a while to bleed off that inventory that these retailers are holding on to. They managed to basically come clean on inventory, so they're matching the sell-in and the sell-through. So they've matched that, and that's what gives me great confidence. They can forecast much better now because they know the true demand. They know what their retailers are going to be ordering. It all flows very seamlessly. Before that, I didn't have that, that level of confidence, but now I do. So I'll be looking for more opportunities. If the share price should pull back after this really nice run, almost a 15% run since earnings, I have no problems, repurchasing some of those shares and, booting them out when they get to a nice profit level. Absolutely.
Now, we have to mention the 500-pound gorilla that is Apple. I mean, they've got a similar product, and can they compete against Apple? Is it possible?
That's a great question. So I want to kind of bracket that question with where we are in terms of market share. So yeah, Apple's Apple in the Apple world and in the consumer's mind. I mean, that's a huge brand. You're never going to beat Apple. But what's worth noting is the most recent market share statistics that came out of Strategy Analytics showed that Xiaomi, which is the Chinese competitor in the wearable space, they have the #1 market share. Fitbit overtook Apple, which used to be in second place, I believe. They overtook Apple for second place in market share. Apple actually dropped down to #3. Fitbit has a very diverse product line. They have pretty much every price point that a consumer, would want. They have an entry-level price point, a mid-level price point, and a higher-end price point. Apple has 2 products: the Apple Watch Series 1, the Apple Watch Series 2. Series 1 is $269. Series 2 is $349. It just depends on the retailer, let's say. But they cater to the Apple customer. So if you're someone who doesn't really know that this is a product for you, that you'll use it, it'll help motivate you, etc., etc., you may never get into this category, and you're certainly not going to spend $300 on the product. But Fitbit, with its low price bar for the Flex 2 at $59.99, enables the consumer to get in, low barrier to entry, and see if it works for them. Gravitate up the chain if it does work for them to a higher priced item, etc., etc. So competing against Apple, Fitbit is actually, I would say, they're in the best position to do so. If any company was in a good position to do so, they are. What Apple is quickly finding out, just like Fitbit, and just like any other company, is this is a really tough category. And the reasons why it's really tough, and nothing really like what Apple has done before, is nobody needs a Fitbit. Nobody needs a wearable. And I don't need this. I really don't. Does it motivate me? Not really, but if I actually want to see my data and see what I did on my run or my workout, I could. But I don't need it. It's a non-essential good. Non-essential goods are really tough sells. It's not a bottled water. It's not a pair of pants.
Right.
I need those things. Otherwise, I may get locked up in public.
Right.
So the Fitbit you don't need. An iPhone. Well, smartphones we need. We've decided as a consumer, we need those. Just by the sheer number of units that have been sold over the last decade, that is a staple. It's an essential good. These wearable products are not essential goods. That's not a category that Apple has really any experience in. So what they're finding out is they've sold a ton of these smartwatches, the Apple Watch, into the retailers, into their distributors. By and large, they're not selling. When you look at Apple's quarterly results, they won't break out the watch sales. And they're smart for not doing that, because when the analysts have caught on to the sequential sales quarter over quarter, they're always going down. And you can see them in the latest strategy analytics market research. Every single quarter goes down and down, which tells you two things. Well, maybe three things. A, it's not an essential good because it's seasonal. Sales are mostly coming in the fourth quarter for the fiscal year, not Apple's fourth quarter per se, but in the fiscal year, which means it's a giftable. And if they're not getting it, during that holiday season, they're not getting it at all. So you have a lot of these, they're just sitting at the retailers and they're constantly having to discount them. Apple, every single year, has had to discount this Apple Watch in a more rapid fashion than they've had to discount any other product that they have ever sold.
Yeah.
So when the Apple fan base says, oh, well, no, that's just because they're coming out with a new one. The average price, the average retail selling price of the Apple Watch 1 was lower than it was the discounted price on average for its entire life cycle. So when it launched, it was $299. The Apple Watch Series 1 only sold at $299 for about 3 months before it was permanently marked down. And it never got back up to its original price. And it was at that reduced price for 10 months before Apple Watch Series 2 came out. So when the Apple fan base says, no, that's just their typical, they do with the iPhones. No, this is very different. And Apple's finding out this is a really tough category because people don't need the product.
Yeah. Interesting. Okay. There's some stocks that I call cult stocks, and I know that sounds pejorative. I would put Tesla in that category. I would put
definitely
GoPro in that category. And when I say cult stock, people either love it or hate it, and they have a dedicated, sometimes small but dedicated following. Some people even put Apple in that category. It may be too big to be a cult stock now.
Some people will never sell their Apple stock.
Yeah.
I don't blame them.
And there's a certain cult of personality attached to Tesla. But we don't really have that with Fitbit. Would you consider that a cult stock?
So if I revisit my experience with SodaStream,
yeah,
I see the same comments, whether it's on StockTwits or whether it's on Twitter. The same exact comments were made about soda back in 2013 to 2015 that are being made about Fitbit over the last year. It's going to go out of business. It'll go bankrupt, or I'll buy it at $1. All those it's a fad. It's those same comments, and I always look at it and I say, so yeah, in that sense, it is a cult stock. People will feel the same way about it, whether they're right or wrong, and they'll live with those consequences. With Fitbit, you have people that just, oh, it's a piece of junk company. It's just Apple's going to kill it. Under Armour was going to kill it. We don't know where the health box is anymore.
Right.
Every company was going to kill Fitbit. But the truth of the matter is, every company that has tried to compete with Fitbit has failed. Samsung is not even on the smartwatch list or on the top 5 wearables list. And we're talking about you want to talk about Apple. Samsung's bigger than Apple.
Right.
So
yeah.
There's something very, that people miss.
Yeah, and Fitbit is still here. It's still here.
Exactly.
It's not going anywhere.
SodaStream is still in business,
Yeah. So you can call it what you want on StockTwits and Twitter. And by the way, I should mention, it's going to be in the description. If you haven't checked out Mr. Seth Golden on Twitter, which is at Seth Marcus. Twitter, you're at Seth CL. On StockTwits, you're at Seth Marcus. I'll put all these in the description. Also, your email, I don't have it memorized. You'll have to tell me that one, but I'll put it in the description as well.
Sure.
check those out, and check out Golden Capital Portfolio. If you have some money saved up, if you have a reasonably sizable account, shall we say, and you want to see the kind of returns Mr. Golden has seen, and I want to ask you about that right now. How are we doing so far this year?
Just hit 120% return on invested capital, largely due to our VIX leveraged ETF core, strategy that we've been using since 2012.
Yeah.
Today was actually a godsend today, where the VIX spiked, pretty sharply. And from our last video review, I had anticipated, some increase in volatility, possibly a pullback in the market, and had prepared the fund for such an event by deleveraging or de-risking, taking some of my allocation out of the VIX leveraged instruments. But in the meantime, I've also been trading. And most of my trades you can find in real time, either on StockTwits or on Twitter. I had several trades over the last couple of days, a short on Kohl's at the top when the market opened. Some of my trades on Fitbit have been working out famously, just doing really well in that regard. I do a lot of swing trading. Some of our large cap investments are, in the past have been Costco. We still maintain Facebook and Microsoft. We're looking at our next, big plunge is probably an investment in Chipotle Mexican Grill, which I'll be having a dedicated article coming out or report as to why we think that we are in the right time frame and the right valuation for, planting the flag and taking the stake on Chipotle, CMG ticker.
Yeah, I'll be interested in that one. I remember reading an article about rats falling from the ceiling and in a particular Chipotle location. So I'm very curious to see what your opinion is on that. But for right now, we're talking about Fitbit. So finally, what's your final word on Fitbit? If you could just sum it up for people who are wondering, should they stay the course if they're in it? Should they accumulate? If it dips, should they buy the dip or should they run away? What do you think?
Yeah, so I think over the next 12 months. And this is assuming that the economy remains on stable footing, consumer spending stays reasonably at the same levels, if not better. I see the company continuing to execute against its objectives for the full scope of this year. And should they meet those objectives, they will emerge from this year a leaner company, prepared to deliver greater profits to shareholders. They have very low comps in this year that they'll be able to, jump over that low bar next year. Clean inventory channels, and then they also have other things on the horizon that they're trying to venture into, whether it's digital health, digital healthcare, corporate health, and different accounts like that. And there's some minimal expansion still yet to capture in Asia Pacific region and some in Europe as well. Ultimately, though, what it comes down to with a company like this, and this is what I forecasted from the very beginning when I initially reported on the company, was January 4th in 2016, a few months after the IPO. And I said, look, what's going to happen to this company? They're going to boom, and then they're going to bust, and then they're going to emerge again. But when they emerge, they're not going to have all of these other companies to compete with around them. And surely enough, we've seen Jawbone completely go out of the market. We've seen Microsoft eliminate their product from the market. And we just recently, understood that Intel was completely out of the market. And then some of the other one, they acquired Pebble. Misfit was acquired by Fossil. So you had a lot of consolidation. And frankly, you've had to have that because nobody can compete with Fitbit for any meaningful stretch of time. The market share that is shown in whether it's IDC or strategy analytics, I always tell people, don't pay any attention to it. It's meaningless because all they're tracking are shipments of the product. That's not market share. Market share is what's in the consumer's hand. How many consumers around the world are using your product? So it's kind of a misnomer that these reporting agencies are actually reporting true market share, and that's not the case. If you're reporting true market share, Fitbit has sold 64 million of these devices since 2008, 2009. Nobody else has sold nearly that much.
Yeah.
The retention rate isn't high. I'm not going to lie to anybody. It might be 50%. So, the user base is much smaller than that, 64 million units sold. But to date, Apple still hasn't sold that many.
Right.
Of the Apple Watch. So, I think Fitbit should see some share price appreciation through the year end and into 2018. I think you'll see a shift in investor sentiment. Vanguard just increased their position pretty nicely. Vanguard tends to be a pretty well-run organization.
Jack Bogle, Jack Bogle's pretty good at what he does, I think.
Yeah.
He has a little bit of experience in this sort of thing. Yeah.
There you go.
Very good. Well, Mr. Seth Golden, more insight coming every time he comes on. I'm going to put up your information here. Let's see. We've got Seth.Golden at coolinxit.com. I'll put that right on the screen in the description. He's very responsive. He'll answer your emails. And if you want to get the kind of returns, I think I heard him say 120% so far this year returns on Golden Capital Portfolio. If you want to get a part of that, if you have a sizable account, why not check it out? Why not at least ask him about it, what he can do for you? Meanwhile, check him out. He actually posts many of his trades on Twitter at SethCL and on StockTwits.com, which is at Seth Marcus. I really appreciate you coming on. I think you have a Fitbit with you, don't you? Don't you have a couple of goodies to show us?
Yeah, I have my old Flex on. This is the one I had purchased for my wife.
Okay.
The Charge 2, the Rose Gold series, she likes that Rose Gold. I also do a lot of consulting, and I do a lot of beta testing for various companies.
Okay.
Did one for Move, a while back.
Nice.
And, I expect the new smartwatch to be out by the fall, let's say September, October timeframe. Fitbit smartwatch and Apple, that was big news as well. Apple's going to have an untethered the smartwatch 3, where, it can make phone calls. I don't know how many people are going to want to talk into their watch or what have you. And I surely don't know that there's a lot of people that want to pay the additional connectivity charge for that watch, which is going to be $30 to $40, and you have to do it.
Yeah.
And then the data plan, it's a separate line. You have to have a separate data plan. All of that drains so much battery, which has been just a real problem. And I'm anxious to see if Fitbit smartwatch can conquer that problem too. The GPS takes up a lot of battery and a lot of space in your smartwatch. So it's going to be interesting to see how both of them coming out with the smartwatch at the same time, pretty much the same time, what the market's going to say. And, I think Amazon's rankings are a really good place where you can go to see what the consumer's buying.
Yeah.
And price is going to matter. Price is going to matter. If both companies come out with the same price, I don't see any more success for the smartwatches per se.
Okay.
Going forward, the fitness trackers have done really well. They're the ones that people buy 4 times greater than they buy the smartwatch in quantity. They buy 4 times more fitness trackers than they do smartwatches. So when people say, hey, Fitbit is, they're pegging themselves to the smartwatch, it's just not true. It's rhetoric. They can do themselves some good if the smartwatch is received well. But the bulk of their business is always going to be done on their fitness tracker line.
Yeah. So much to absorb, so much information. If you want a part of this, contact Mr. Seth Golden. Check out his tweets. Go to StockTwits. Check it out there. Free educational content. Check out the Golden Capital Portfolio. I learned a lot more about Fitbit in the last 15 minutes than I ever thought I would know. And, that company is looking pretty good to me right now. Mr. Seth Golden, you're welcome back anytime. I can't wait to see what you have to say about Chipotle. And, of course, I'm always watching your UVXY short trades, which are so profitable. Mr. Seth Golden, thank you so much, and I hope to see you and hear you again soon on Looking at the Markets.
Much appreciated. Take care, David.
Yeah, mate. Take it, take it, take it. They're gonna take it off me. Take it, take it. They're gonna take it off me. Take it, take it.